Monday, September 15th, 2008. The exact day the music stopped and the global financial system flatlined. What looked like just another bad Wall Street morning was actually the start of a full-scale financial panic that would spill into every corner of the global economy. A 158-year-old titan of American finance did not just stumble, it completely collapsed. Lehman Brothers filed for Chapter 11 bankruptcy protection, becoming the single largest bankruptcy filing in United States history. The numbers were almost too absurd to process. Lehman was carrying roughly $639 billion in assets and about $619 billion in debt. That is the kind of balance sheet so enormous it stops feeling real until it detonates. Within hours, trading floors were infected with panic. Screens bled red. Phones rang without answers. Traders were not just worried about Lehman. They were suddenly asking a much more terrifying question. Who is next? The Dow Jones plunged by roughly 500 points that day, one of the worst single-day falls since the aftermath of 9/11. But that was just the visible damage. The invisible damage was far worse. Lehman's failure froze into bank lending, terrified credit markets, and helped trigger a global wealth wipeout estimated at around $10 trillion. One firm fell, and the world suddenly remembered that modern finance runs on trust, and trust had just evaporated. So how does that happen? How does a firm that survived the Civil War, the Great Depression, and 2 world wars suddenly become the institution that helped break the modern global economy? The short answer is leverage. The longer answer is leverage, bad incentives, toxic mortgages, accounting tricks, short-term funding, and a leadership team that kept betting bigger, even as the floor cracked beneath them. To understand how the house of cards collapsed, we have to go back to how Lehman Brothers actually made money, and how Wall Street slowly turned home loans into a machine for printing fake prosperity. Lehman Brothers began as a modest business in the 1800s, eventually evolving into one of Wall Street's most aggressive investment banks. By the 1990s and early 2000s, it was no longer just participating in financial markets. It was feeding on them. An investment bank does not make money like a normal bank. It trades, it underwrites deals, it borrows cheaply, and invests aggressively. In good times, this looks brilliant. In bad times, it becomes a flamethrower pointed at your own balance sheet. Lehman loved leverage. And leverage is one of the most dangerous words in finance because it makes you feel richer than you are. You borrow more money to make bigger bets, which means even small mistakes can become fatal. Think of leverage like buying a mansion with almost none of your own money. If prices go up, you look like a genius. If prices fall even slightly, you are suddenly underwater and gasping for air. That was Lehman's game. Borrow a lot, buy a lot, hold a lot. And because the housing market kept rising, the strategy looked unstoppable. Wall Street mistook a bubble for brilliance. In the early 2000s, America was in a housing frenzy. Home prices were climbing, credit was loose. Mortgage brokers were handing out loans to people who had no business taking on that kind of debt. This is where subprime mortgages enter the story. These were loans made to riskier borrowers, people with weak credit, unstable income, or tiny down payments. In plain English, loans that worked beautifully until they didn't. But Wall Street found a way to make even bad loans look good. They bundled mortgages together into mortgage-backed securities, chopped them into slices, and sold them to investors around the world as if risk had magically disappeared. It did not disappear, it was simply repackaged. Toxic debt went into the box. A fancy label went on the outside, and investors, pension funds, and institutions were told these products were safe, diversified, and often rated AAA. Lehman did not just participate in this machine, it became deeply dependent on it. The firm originated mortgages, packaged them, sold them, traded them, and held huge amounts of real estate-related assets on its own books. That meant Lehman was not standing near the housing bubble. It was standing inside it, feeding it, and using borrowed money to make the bet even bigger. And here is where the danger multiplies. Lehman was financing long-term, risky real estate bets with short-term borrowing. In other words, it was using fragile day-to-day funding to support a mountain of assets that could not be sold quickly. This is one of the most important ideas in the whole story. Lehman was not just vulnerable to losses, it was vulnerable to a confidence shock. If lenders stopped trusting it for even a few days, the entire machine could suffocate. For a while, nobody cared. The profits were too good. Housing prices kept climbing. Executives got paid. Investors stayed happy. Ratings agencies stayed generous. And on Wall Street, easy money has a way of making stupidity look sophisticated. Then the housing market began to crack. Prices slowed. Borrowers started missing payments. Delinquencies rose. And the magical assumption that home prices could only go up started to look like the most expensive delusion in finance. Once defaults started rising, mortgage-backed securities stopped looking like brilliant innovations and started looking like time bombs. Suddenly, investors wanted to know what was actually inside all those shiny packages. Lehman's problem was simple and deadly. It had too much exposure to a market that was turning toxic and too little room to absorb a serious hit. The same leverage that magnified profits was now magnifying losses. And still, management kept trying to project strength. Publicly, Lehman insisted it was well capitalized. Publicly, it insisted the market was overreacting. Publicly, it acted like this was just a temporary storm. Behind the scenes, the firm was far more desperate. It was scrambling to unload assets, raise capital, and calm lenders who were starting to wonder if Lehman's numbers could actually be trusted. This is where Repo 105 enters the story, one of the most infamous accounting maneuvers of the crisis. Lehman temporarily moved tens of billions of dollars of assets off its balance sheet right before reporting periods to make its leverage look lower than it really was. In plain English, Lehman was cleaning its room just long enough for investors to walk through the front door. The mess did not disappear. It was just shoved into the closet for a moment. That kind of trick can buy time. It cannot buy trust. And once the market starts doubting a highly leveraged institution, time is exactly what you no longer have. By 2008, the financial system was already fragile. Bear Stearns had collapsed earlier that year and was rescued in a shotgun deal. That rescue created a dangerous expectation. If things got bad enough, maybe Washington would save everyone. That expectation mattered. If markets believe the government will step in, they stay calmer longer. But if that belief suddenly breaks, the panic becomes much worse because everyone realizes they mispriced the risk. Lehman entered the summer of 2008 already wounded. Losses were mounting. The stock price was sliding. Confidence was eroding. And unlike a normal company, a bank cannot survive long after a confidence disappears. Why? Because a bank's business model is built on trust. Clients trust deposits. Lenders trust repayment. Counterparties trust contracts. Take away that trust, and the institution becomes a shell with expensive wallpaper. By September, Lehman was in emergency mode. A rescue or sale was urgently needed. The weekend before bankruptcy became one of the most intense crisis meetings in modern financial history. Regulators, bankers, and executives gathered in New York trying to engineer a private sector rescue. Barclays was interested. Bank of America looked at the deal. Everyone knew failure would be catastrophic, but the rescue never came together. Bank of America turned to Merrill Lynch instead. Barclays ran into regulatory obstacles. And unlike Bear Stearns, Lehman did not receive the same kind of government-assisted lifeline. This is one of the most debated questions of the entire crisis. Why was Lehman allowed to fail? Some say the government wanted to draw a line against moral hazard. Others say officials simply lacked a workable legal and political option. Whatever the reason, the result was brutal. Markets interpreted the failure as a terrifying signal. If Lehman can go down, then any major institution might be vulnerable. Suddenly, nobody knew who was safe. That uncertainty is what froze the system. Banks stopped trusting banks. Money market funds panicked. Short-term lending seized up. Credit did not just get expensive. In many places, it stopped moving at all. When credit freezes, the damage jumps from Wall Street to Main Street fast. Businesses struggle to fund payroll. Consumers cannot borrow normally. Investment slows. Layoffs rise. Panic in finance becomes pain in everyday life. And that is why Lehman mattered so much. It was not just a big bankruptcy. It was a confidence grenade thrown into the center of a leveraged global system already soaked in gasoline. The firm's death also exposed just how opaque modern finance had become. Nobody was fully sure who held what, who owed what, or how far the losses would spread. Complexity had become a weapon against clarity. And remember, Lehman did not fail because of one bad trade. It failed because an entire model depended on rising home prices, constant access to cheap funding, and the belief that tomorrow would always look like yesterday. It makes you look brilliant on the way up and defenseless on the way down. It shortens the distance between success and extinction. There is another lesson too. Liquidity and solvency are not the same thing. A firm can own lots of assets on paper and still die if it cannot turn those assets into cash when fear hits. That was Lehman's problem. On paper, it had enormous assets. In reality, those assets were tied to a collapsing market and could not be converted cleanly into the trust or cash the firm desperately needed. Lehman also showed how dangerous incentives can be. Mortgage originators wanted volume, investment banks wanted fees, ratings agencies wanted clients. Everyone got paid up front, while the real risk sat quietly in the future. That is how bubbles become system-wide disasters. Bad incentives do not stay isolated. They spread through the entire machine until almost everyone is rewarded for pretending the risk is smaller than it is. After Lehman failed, governments and central banks had no choice but to respond far more aggressively. The fear was simple. If they did not flood the system with support, the entire global financial architecture could unravel. And that is exactly why Lehman still matters. It became the moment policymakers, investors, and ordinary people learned what happens when leverage, opacity, and misplaced confidence all collide at once. It was not just the fall of one bank. It was the exposure of an entire illusion that sophisticated markets, complex models, and elite institutions automatically know what they are doing. They don't always. Sometimes they are just better-dressed gamblers. The final truth is uncomfortable. Lehman Brothers did not break the world alone. It was one of the largest pieces in a much bigger machine of cheap money, reckless lending, weak oversight, and institutional denial. But when that one giant gear snapped, the machine seized, and that seizure changed everything, from markets to regulation to central banking to the way an entire generation thinks about Wall Street. So when people ask how Lehman Brothers broke the world, the answer is not that it was uniquely evil or uniquely stupid. The answer is more dangerous. It was a perfect product of a system that rewarded risk right until the second it exploded. That is why the story still matters today. Because markets still love leverage, institutions still love complexity, and every boom still whispers the same seductive lie. This time is different. Usually it isn't. And that may be the most expensive lesson Lehman Brothers ever taught the world. What do you think? Was Lehman's collapse mainly about leverage, toxic mortgages, bad leadership, or a system designed to hide risk until it was too late? Drop your thoughts in the comments. If you enjoyed this breakdown of how a $600 billion house of cards helped break the world, hit subscribe, and I will see you in the next one. If you enjoyed the story of the $600 billion house of cards, how Lehman Brothers broke the world, then you'll love the story of who is Satoshi Nakamoto, the greatest mystery in finance. Click the video on your screen now. I'll see you there.